Welcoming you to Skilled MBA Case Study Series in Accounting, Infosys adeptly navigates Indian Accounting Standards 115, ensuring transparent revenue recognition. This standard impacts how contracts are evaluated, affecting reported earnings. By focusing on performance obligations and transaction price allocation, Infosys maintains high earnings quality. This approach not only aligns with global practices but also enhances investor confidence in their financial disclosures. Infosys operates globally, serving international clients with a focus on digital transformation, software development, and enterprise consulting. As India's second-largest IT firm by 2024, it plays a crucial role in the technology services sector, with most revenue generated from overseas markets. Investor scrutiny intensifies as focus shifts to earnings quality, assessing sustainability beyond mere numbers. Complexities in revenue recognition arise from multi-year contracts and bundled services, posing significant accounting challenges. Adhering to new regulatory standards requires rigorous application and transparent reporting, ensuring compliance and maintaining investor trust. Indian Accounting Standards 115 requires identifying enforceable contracts with commercial substance. Each contract's distinct performance obligations must be recognized. The transaction price, including variable components, is determined and allocated to these obligations. Revenue is recorded when control transfers to customers, ensuring accurate financial reporting. Infosys's financials are significantly influenced by Indian Accounting Standards 115. Revenue recognition aligns with performance obligations, impacting reported earnings. Contract modifications and variable considerations affect transaction prices. These changes necessitate careful analysis of financial statements to understand true revenue streams and profitability. Monitoring these elements is crucial for accurate financial analysis and strategic decision-making. Analyzing key financial metrics is crucial. Revenue growth rate highlights consistency, with sharp changes needing scrutiny. Accounts receivable turnover measures collection efficiency. A decline may signal revenue quality issues. Operating margin stability reflects pricing power, while volatility demands investigation. Increasing unbilled revenue as a sales percentage prompts questions on recognition timing. The critical cash flow test evaluates how well-reported income converts to actual cash. Cash flow from operations should align with reported income. Significant divergence is concerning. A cash-to-income ratio of 0.97 indicates robust financial health. An operating margin of 21.5% reflects efficient cost management. Days sales outstanding at 41 days measures collection efficiency. Comparing industry peers, Infosys shows a revenue growth of 7.5%, with a strong operating margin of 21.5% and a cash-to-income ratio of 0.97. TCS leads with 8.1% growth and a 23.7% margin, while Wipro and HCL Tech trail with lower metrics, indicating varying financial health and operational efficiency. Contract analysis is crucial in revenue recognition. Fixed-price projects use the percentage of completion method, demanding accurate cost and progress estimates. Time and material contracts recognize revenue based on billable hours, reducing misstatement risk. Bundled services require transaction price allocation to distinct obligations. Maintenance contracts recognize revenue over time as services are rendered, typically straightforward. Accelerated revenue recognition occurs when revenue is recorded before performance obligations are met, raising concerns. Inconsistent estimations involve changing completion percentages without clear justification, which can distort financial results. Frequent contract modifications affecting revenue timing may indicate manipulation. Unbilled revenue growth that outpaces recognized revenue suggests potential issues in revenue reporting accuracy. Evaluate the consistency of revenue recognition policies across quarters. Examine if performance obligations are clearly defined in client agreements. Assess systems for accurate measurement of completion percentages. Determine what portion of contract value is typically deferred to future periods, ensuring transparency and compliance with accounting standards. The fiscal year 2023-24 analysis reveals strong fundamentals with consistent cash flow conversion, validating reported earnings. A conservative approach to revenue recognition under Indian Accounting Standards 115 ensures responsible application. Transparent segment reporting enhances analytical clarity, while sustainable growth is evidenced by revenue increases supported by verifiable business expansion. Interpreting accounting rules requires aligning them with economic realities, not just technical compliance. Develop critical thinking to evaluate earnings quality effectively. Grasp sector-specific revenue recognition challenges, especially in information technology services, to enhance analytical judgment. Financial analysts should prioritize understanding beyond mere compliance. Technical adherence to standards doesn't ensure quality earnings. Analyze patterns over multiple periods and compare industry practices. Investigate significant differences in how peers apply standards. Ultimately, cash flow validation is crucial. Carefully track conversion rates to assess earnings quality effectively. Thank you, and explore Skilled MBA for comprehensive financial analysis case studies on international accounting standards. Benefit from expert training by industry professionals and earn specialized certifications to boost your resume. Engage with a community of finance professionals and students for insightful discussions. Visit skilledmba.com for more information.